good. Well, welcome. This is the Know Your Numbers podcast, a Better Books broadcast. I have with me a fellow accountant in the name of Ryan Pulice. He is the managing director of the Pulice Group, and he's down in the Virginia area, and he specializes in the real estate tax code and has helped many clients lower their tax burden, and business owners, real estate investors, all of the like. He also has an ebook out there that I saw, Real Estate Investor Tax Guide. Is that right, Ryan?
Yeah, exactly. That's on my website at thepulicegroup.com under tools and resources.
Okay.
About 20 pages or so of different tax strategies for real estate investors.
Right. Well, that's what we'll be getting into a little bit today. I gave you a very generic introduction. So if you want to give a little bit more of a background on who you are, what got you into this space, and where you find yourself these days, that'd be great.
Okay, yeah, sure. So I started the Pulice Group back in 2012 and have been building out my niche in real estate the last several years. We do work with all sorts of small business owners, but we've really been doing a lot of work in the real estate world. So real estate investors and small business owners are our niche area. And we also do a lot of tax planning, which different from your typical transactional approach where, you get together once a year, maybe a quick conversation at year end. And, outside of that, it's really just a transaction a year. What we try to do is build a year-round relationship and focus on planning, because there's much more you can do throughout the year before December 31st than you can after that January 1st cutoff.
Right.
There's not a whole lot you can do in February to adjust your taxes for the prior year. So we really work closely with our clients to focus on the tax planning to really help them save money in taxes.
Yeah, that's good. And yeah, so you've been in the business for about, I guess that's almost 10 years now.
Almost 10 years, yeah.
Yeah. What were you doing prior to owning your own thing and running your own
So
shop?
I worked in, I did audit for a few years, got my CPA.
Yeah.
Worked in private industry for a while. I was CFO at a logistics company, worked at a law firm, an actuary firm. So spent a few years in each one. And I was actually still working full-time up until just 3 years ago. And that's when I went out full-time on my own. So I'd started off initially doing this as more of a side hustle.
Yep.
And then branched out on my own, and been growing pretty well ever since.
Yeah, that's awesome, man. And yeah, so that's interesting, because I started in audit as well, and now I see that tax is a little more in demand for clients out there. So I might need to pick your brain a little bit.
Exactly.
But we won't bore the listeners with that. I do want to to get into the real estate and the business owner aspect of things, and one thing I do want to touch upon is some of the tax advantages for small businesses. You hear a lot about LLCs and starting an LLC so you can get the business deductions, but I think a lot of people are starting to be turned on to this idea of the S corporation and some of the tax advantages that come from being designed as an S corp. If you could just go into a little bit of that, and how do you advise some clients to set up their businesses if they're just getting started, or whether they've been in business for a couple of years with their LLC? Is S corp the way to go, or does it depend?
It's really going to depend on the type of business. So if you're a real estate investor, no, you want to stay away from an S corp unless you're flipping. Okay. So if you're doing fix and flips, or you're a little more advanced in doing real estate development, then it makes sense, because that type of income is going to be treated as ordinary income. So the S corporation structure would make sense, where you could pay yourself a salary and minimize the self-employment taxes that you would otherwise pay on everything if you were set up as just, say, a single member LLC without that S election. So now, if you are going that route, what I generally advise is to hold off doing the S election until you're somewhere around 50,000 or so in net profit.
Okay.
That way, with an S election, you have to pay what the IRS calls a reasonable salary. They don't really define that. So you have if you're by yourself and operating as a single member LLC and you make an S election, a few things are going to happen. You'll need to set up payroll and pay yourself a reasonable salary. And also you're going to have a separate tax return, where a single member LLC is just going to be reported on your personal tax return. An S corporation has its own tax return,
Right.
and income passes through on a K-1.
Okay.
So when you're in that S structure, there's really two parts to your income. There's your salary that you're going to pay through payroll, and then the rest, everything else gets passed through to you. So let's say your company had $100,000 in profit and you decide you should be paying yourself a $40,000 salary. That's reasonable.
Yep.
So $40,000 of your income is going to come to you on a W-2 and will be subject to the FICA, your Social Security and Medicare taxes. The other 60,000 is going to pass through on a K-1 as ordinary income, and it's not subject to the self-employment taxes, which when you do the employer and employee side for those, when you're self-employed, that's 15.3%. So it can save you a fair amount of money, especially as your numbers get larger.
Right. Wow. Yeah, that's one thing I started to realize, but I do like how you left the profit margin at, or the profit number at 50,000. You kind of everything below that, it sounds pretty reasonable to stay as an LLC. You don't really get the benefit.
Yeah, because the tax savings just aren't there. When you
Yep.
pay to have a separate tax return done for the S corporation rather than just your personal, you have an added cost. If you're going to set up payroll, they're relatively inexpensive, but you can figure about $100 a month in payroll processing fees. So you have these additional costs. You want to make sure your tax savings exceed those additional costs to make it worth it. And it
Yep.
usually falls in right around that 50K mark or so.
Okay. Do you find yourself advising clients, and maybe you don't even take on clients that are in this low level, but like, do you find yourself assisting clients in increasing profit, or do you just strictly leave it as the tax guy and this is what I'll help you do?
Well, it's a little bit of both. So we also do outsource CFO work and
Okay.
controller work.
Yep.
So if someone comes to us, let's say with a real estate deal and wants help looking at the numbers, we'll put together in a spreadsheet some calculations for them, based on their inputs and any numbers we need to estimate. We'll do our best to kind of get a reasonable ballpark in there. And we'll show them what the cash on cash return would look like, what their after tax investment returns are going to look like.
Yep.
So we try to do a little more, especially for those clients of ours that we work with on planning purposes.
Yep.
Kind of do the whole thing from beginning to end with them.
That's cool. And so how big is your team, Ryan? Is it just you, or it sounds like you have a couple
There's two of us, and then during peak times we hire some contractors, and we're going to be looking to bring on another professional here shortly.
Okay, I got you.
So
I'm curious because I'm starting this, and I'm as a guy that's seen the ropes and been through the weeds a little bit. I'm picking your brain, but I will turn back to the real estate stuff because that's what people are interested
no problem.
in.
Ask whatever you want.
Amen. That's awesome. Yeah. So you do have some real estate investment properties of your own, is that correct?
Yes, that's right.
And how did you find real estate? Was it the accounting that got you into real estate, or the real estate that got you into the accounting?
It was the accounting that got me into the real estate. So starting out, well, partly, and then also family. My dad had owned some real estate. I've had other family members, cousins that are in real estate as well. So I've kind of had got the bug a little early and then got started on my own investing.
Yeah, that's cool. And so what are some of the tax strategies that you do recommend to investors? I know there's plenty, but I'd like to hear, and it's probably, I would encourage people to go get the tax guide that you have out, the ebook. It sounds like there's a lot of wisdom in there, but for now, what do you advise, and what can we find in your ebook or your tax guide?
So what I always look at when someone new comes to me, is we'll review prior year returns for tax planning opportunities.
Mm-hmm.
And one that we always check for is, are there opportunities to do a cost segregation study? Okay. So even with relatively smaller investment properties, you can go, there's a company, it's called, KBKG, where you can provide them information about the property and for a relatively inexpensive cost, unlike a engineering-based cost sake study that can run you $5 to $7 grand.
Yep.
Under $1,000, and they can give you a report on some pretty decent components to use for the cost seg, and end up saving some money there, especially if you've got an investor that can qualify for real estate professional status. Use the bonus depreciation with based on the cost seg study to really just accelerate the depreciation into the current year. So we've had a lot of success using that strategy. That in the real estate professional status, especially if you have a non-working spouse that can qualify, that really opens up a lot of doors.
Okay. And so what is that real estate professional? Do you have to be an agent, or can you?
And you can qualify as an agent. So real estate professional status actually comes in from section 469 of the tax code, which governs passive loss limitations. So basically, your passive activities are rental real estate by default, and then any businesses you are a part owner of that you don't actively participate in, or you're just an investor. Those are your two main passive activity categories. So by default, rental real estate is passive unless you qualify as a real estate professional. And the IRS lists it's about 10 or 11 different categories: construction, real estate agents. They call them brokers, but agents qualify. There's court cases out there that solidify that position. If you're in the operations side. So if you spend, they call them real estate trades or businesses. If you spend 750 hours a year working in one of those industries, and more than 50% of your time is spent in a real estate business, you can qualify for this real estate professional status. And after you qualify based on those two tests, you have to meet material participation, which usually that's 500 hours or more on a property or activity, or you can qualify by spending 100 hours or more and more than anyone else. So if you have a property manager that's spending 200 hours, you would have to spend 201 hours to hit more than 100 hours and more than anyone else. Or another common way to qualify is if it's just you, you're doing substantially all the work. So you don't need 100 hours. You could probably get away with 50, 60 hours if you're self-managing and doing everything to hit that material participation, which is after the two tests to qualify as a real estate professional. By passing both, you can deduct all of your real estate losses.
Wow.
So that's, for most people, they sit out there suspended until you dispose of the property or you have other passive income to absorb those losses. Qualifying as a real estate professional allows you to deduct them all against your other income, like W-2 wages and active businesses. So it's really a great strategy. It's just difficult to do if you have a full-time W-2 job. You're not going to qualify. Right. Because the IRS assumes, okay, you're working 2,000 hours, 2,080 hours in this W-2 job. That means you would need to spend 2,081 hours in your real estate businesses to hit that threshold. Right.
And we all know that time is a little limited.
Exactly. So you 4,100 hours plus a year. Good luck proving that in court. It's not going to work. But if you have a house or a spouse that's a homemaker, they can qualify.
Wow. That's good. So what section is that again? Sorry.
So the passive activity losses are section 469 of the Internal Revenue Code. And within that they discuss the real estate professional status. So what happened was back in the day before 1986, you can write off all your rental losses. There were no restrictions. So in 1986, Congress passed Congress wrote in this 469 section of the code that limited that. And for a number of years, even the real estate professional status wasn't there. But, you know, a lot of folks in the industry are like, hey, this isn't fair. I work in the industry. You know, if you're a developer and you're building properties and selling them, but you want to hang on to a few to rent out, you're not allowed to offset those rental losses against your other income. But if you're a dentist and you have two offices and one is profitable and the second has a loss, they're allowed to offset their income with losses. So I think it was 94 or so, they added in this real estate professional status that allowed people that are in the real estate trades and businesses to start using those losses to offset other income from their real estate activities.
Wow, that's awesome.
A little history there.
Yeah, that's good. Now, what is your, so obviously you're very, what do I say, well versed in the tax code, right? And you have to be in your position. How have you gotten to that point? And like, are you constantly reading the tax code and reading updates, or like, is it practice and doing it for clients, or?
Yeah, it's really a combination of both. You have to stay on top of the changes that I feel like the changes are becoming more and more lately.
Right.
But and just by doing it, you really, you know, you can print out the code for free online in the Treasury regulations that go with it. And reading through the guidance, some of the stuff may stick, but until you start doing it, at least for me, that's how I learned.
Right.
As you're doing it, the stuff begins to click, and you're like, okay, yeah. Now it just becomes like it's almost second nature.
Yeah.
And you know, you almost don't have to think about it anymore. So
Right.
it's really just doing the stuff over and over. You know, whether it's the cost seg studies or
right.
You know, explaining the stuff to clients, how the passive activity rules work and ways to navigate around them legally without getting in trouble.
Yeah.
It just eventually sticks in and becomes part of your memory.
Right. Yeah, that's good. Learn by doing. I like that.
Exactly. Yeah. Action's where it's all at.
Amen. Now you talked about the legal issues. Do you team up with lawyers, or do you have a team of lawyers that helps you out, or you don't have
There's
a lot
a few I work with that I refer to, but we don't have any in-house or any sort of arrangement with any. No.
Okay.
There's a group actually that I've referred people to several times, KKOS. I think they're based in Salt Lake City or something in that area.
Yeah.
But they are CPAs and tax attorneys, and I've used them for my own operating agreements because they do a really great job with on the legal side. So I've personally used them, and I'm comfortable referring people to them. And then, you know, there's just others in my network that I know that I'll refer people to if they want someone local as well.
That's good. That's awesome. And now, so for somebody who is just getting started, I'll take it back to the business a little bit and like the LLC startup and some of the recommendations you might have there. There's some states that allow or are better to incorporate in and better to get your LLC in if you're in real estate specifically. I know like Wyoming, and this might be more of a legal matter, but if somebody's looking to get started in real estate, they have everything except for the actual business. Are there any recommendations you can make in terms of tax advantages or just planning for the future, or is it kind of?
Yeah, so the LLC itself really does become more of a legal question. An LLC doesn't provide any tax advantages.
Okay.
It's a liability protection. Now, if you make an election to be taxed as an S corporation with an LLC, then you have tax implications.
Right.
But the LLC itself is really just it's there for liability protection. Now, you know, you'd be best speaking to a lawyer about the best states to set up in. I've heard the same thing. I know Wyoming, Nevada's a popular one.
Right.
A lot of that has to do with, and again, you know, I'm not a lawyer, but from talking to them enough, it has to do with your protection offered by that state and the privacy. Some
Yeah.
states have better privacy about what they'll release as who's on the incorporating documents for the
Right.
LLC. One thing to know, though, if you're investing in, say Florida or Virginia, and you set up a Wyoming LLC, you still have to register in the state where your property is, because that's where the operations are. So by setting up an LLC in another state where the property is not located, you end up paying twice on some of those fees. You're going to have fees with the Secretary of State or their equivalent for each state where your LLC, it's set up in Wyoming, let's say, and owns a property in Virginia.
Yeah.
Then you're doubling up on those fees. Now, if you have those fees typically aren't very much, a few $100.
Right.
So if you have a pretty sizable portfolio and you're going more for the asset protection, charging order protection, that sort of stuff, those legal things that your lawyer can better explain to you, then it starts to make sense. But if you have one rental property, and check with your lawyer, but I think you're better off sticking to where you're doing business and keeping the fees down, at least initially.
Right. And yeah, let's preface that conversation, or go back and say that Ryan is here on his own terms, and don't take any of this advice for
exactly
straight up accounting advice or legal advice.
That is just my opinion on the LLC stuff.
That's good. Well, we appreciate that.
That's why I keep saying, ask your lawyer.
Right. So that's good, man. And so we did touch upon a little bit, or you did, on the depreciation and the benefits of accelerated depreciation. Let's dive a little bit further into that, because I know that's one of the biggest advantages. And when it comes to accelerated depreciation, what do you mean by that, and what do you advise clients to do? Because I know you can get depreciation on the house, but there's sometimes more than just the house or the apartment building in terms of like furniture and vehicles and stuff like that.
Yeah, exactly. So right now, the way the code's written, there's what they call it bonus depreciation.
Mm-hmm.
So you can write off 100% of the cost of assets that have a life of less than 20 years. So you can't do that with your building. If it's a residential building, you're going to straight line that over 27 and a half years. If it's a non-residential building, it's over 39 years.
Right.
But other items, and this is where the cost segregation study comes into play.
Mm-hmm.
There's different components of the building. A good cost seg study will break out items in the building that may otherwise have been lumped in with the building itself as under the 27 and a half or 39 years. They're going to carve out components that are depreciated over 5 years, 7 years, 15 years. And that's where you can take the bonus depreciation. So in general, and this is just kind of a rough ballpark, if you buy a new property and pay to have a cost segregation study done, you can expect about 20%, maybe a little more, maybe you can get up to 25%, but just to be conservative, say 20% of that cost is going to be allocated to these 5, 7, or 15-year asset lives that you can bonus depreciate and write off right away.
Wow.
So if we assume 20% is a good number, and you buy a property, you put 20% down and borrow the other 80, you can write off all of your down payment in that first year,
right,
if everything kind of lines up properly, and you're actually able to deduct it and not restricted by passive loss limitations or anything like that.
Wow.
So it becomes really powerful. Depreciation is one of those, a lot of people refer to it as a phantom expense.
Yeah.
It's a non-cash. You're not paying for it, but you get to take the expense on your tax return. So it's really a powerful thing, especially for real estate investors.
Yeah. Wow. So that's let's see. So when you're analyzing, or when you have a client analyzing a deal, do you take that into account right away, or is it kind of like after the fact, and you're talking through what's being done after they already have the property in their hands?
But you can do both. So if we're looking at a deal, we take that into consideration up front based on what we know about their tax circumstances. Like, are they going to be able to use this? Or, is this guy working full-time, spouse works full-time? Aren't going to qualify as real estate professionals. Their income's too high, so they're already limited by the passive loss rules. So does it make sense to try to write off all this or use a cost savings study to write off all this bonus depreciation just to have it suspended? Oh, probably not, but maybe they have other passive income that can be offset with it. And in that case, then it would make sense. So it really becomes a case-by-case analysis and dependent on the taxpayer's circumstances. But, and if it's someone new that's come in that already has properties, you can still do a cost savings study and go back and either amend, or if they bought the property more than a few years ago, rather than amending, you file what's called a Form 3115 for a change in accounting method to update their, you're able to change the way you're depreciating these assets based on what the cost savings study results tell you. And take advantage of those benefits that way.
Yeah. Wow, that's good.
But you can do, there's a lot you can do there, whether it's a current buy or even something that's already been done.
Yeah. And folks, if you're listening to this and that's something that speaks to you, we advise that you take it to your accountant and talk to them. And now actually that reminds me, Ryan, are there certain things that you find that some accountants just won't talk about or won't do? Because people hear accountants, and there's a lot of people that are frustrated with accountants that think they can be getting a better tax deduction. Is there something that somebody should be looking for if they're curious as to whether they're maximizing everything?
In my opinion, the best way to weed out, if you're looking for a CPA, is ask them if they offer tax planning. A lot of times what'll happen is you get into a new relationship, and this is true of even CPAs that do the tax planning. If you're not actively engaged in that type of work with your CPA and you just talk to them once a year and provide your tax information in January, February, March, whenever, and you're not in contact throughout the year, there's not a whole lot they can do. So they'll prepare your return and they'll probably send you a handful of suggestions of what you could do. Maybe one or two apply to this year or a few for the next year. Ideally, the CPA would be saying we should meet later in the year and discuss what we can do.
Right.
But if you're happy with them and they do good work, maybe just take that extra step and ask them, hey, I'd really like to talk about tax planning. Is there anything you see on my return that we can do? And I think you'd find a fair amount are going to be receptive to that and able to work on strategies to help. And then others, unfortunately, there's a lot that just they either don't know or they feel like, oh, this might be too risky. They're scared of IRS audits, which isn't something you should really be scared of. They're not fun, but if you're doing things properly and you have the documentation is key. And there's nothing to worry about with an audit. It's going to be a pain. It's going to be a headache. It's going to cost you money. But and odds are, if you're doing everything by the book, you're probably not going to be. I shouldn't say you probably won't. The risks of you being audited are not very high,
right?
If you're not taking positions that are in line with the tax code. I mean, the IRS knows what real estate professional status is. Right. They see this all the time. It could be challenged a lot, and it's probably likely to be challenged if you've got both spouses with significant W-2 income. But they know what they're looking for, and it's nothing to be scared of. But unfortunately, a lot of accountants do get scared.
Yeah, that's right. And business owners too, but
oh yeah. I understand business owners being scared because they don't deal with it every day, like many accountants do. But I don't feel like CPAs should be afraid of the IRS audits. They should be prepared and know how to work through them and
Yeah.
come out successfully.
Right.
Which
And
that's
it
what
also
tax
brings us
planning is all
business,
about.
right? Like that's how we get business is
Yeah, exactly.
That's cool. Now, Ryan, I do want to be cognizant of your time. I appreciate everything you've provided thus far, and I do like to close with a little insight into some things that you follow, whether that be information or podcasts or books that you might recommend. Are there any education outlets that people might benefit from that they might not hear from a typical investor, whether that be a book that you'd recommend, or what's your favorite book of business or personal? I like to find out.
One book I really enjoyed that I read recently, I don't know how much it really goes into or falls into the business category, is Skin in the Game
Oh yeah,
by
Nassim, right?
Nassim Taleb, who
Yeah,
wrote
yeah,
Black Swan. That was a good one. That was I really enjoyed that.
yeah.
And I'm reading Mastery right now, which is by Robert Greene. He
Yep.
wrote 48 Laws of Power. This talks
Yeah.
about mastering a subject and kind
Right.
of touches on the 10,000 hour rule. So
Yeah,
that's another good one that
that's cool.
I'm enjoying that.
Now on that topic actually is mentorship. Do you have any specific mentors that have helped you get to where you are, or people that you look up to?
Yeah,
Or...
so yeah, I've had a few mentors, and I do think they're important. You just having someone to talk to and to reach out to, just whether it's just general advice
Yeah.
about your business and growing it, or specific to the type of work you do. For me, some of it comes in the form of just different groups that, I don't want to use mastermind
No.
because that's a little, I think you get a different perception with that, but
Right.
just different groups of folks that for me personally, there's some that they are specific to the tax and accounting industry and tax planning, and just get together once a month, once a quarter, and bounce ideas off each other. And then the one-on-one as well, if you can find someone that's that's been in your shoes before.
Yeah.
They're going to have a lot of knowledge, and just listen when they try to help.
Right. Wow. Well, that helps me quite a bit. And as a result, I think I'll be reaching out to you shortly
Yeah,
after this
absolutely.
podcast. But I do really appreciate you coming on here and sharing your wisdom, man. I'm psyched for you, and honestly psyched for our listeners to be able to get a little point of view that they might not always get. So thank you, Ryan. Is there anything that we can do for you, or people want to learn more about you or seek out your business? How can they connect?
Yeah, if anyone would like to talk more, or if they're interested in tax planning, we'd be happy to take a look at your prior year returns and let you know what we see. They can go to my webpage. That's thepulicegroup.com. So ThePulicegroup.com and /contact. You can fill out your information in there, and I'll get an email and reach out to you.
That's awesome, man. Well,
yeah,
listen to him. Go seek him out. And yeah, Ryan, this has been a pleasure, and I look forward to talking with you more. Thank you for all
yeah,
you do.
Absolutely. Anytime. Happy to talk anytime.
Talk soon, man.
All right. Talk to you later.